For a closer perspective of the market, let's bring in Sam Stovall, Chief Investment Strategist at Standard & Poor's. He is also the author of The 7 Rules of Wall Street, and he joins us now from his office here in New York. Sam, welcome back to Bottom Line. Always a pleasure to have you on.
Good to talk to you again, Mark.
Sam, today's sell-off, does it mean the market's already pricing in the apparent failure of these supercommittee talks?
I think it tried to do a lot of that last week. We had all 10 sectors in the S&P 1500 decline, and we had 144 out of the 148 sub-industries in the red column last week. And I think this is simply a continuation of the crisis of confidence directed toward our political leaders.
Sam, if the panel does in fact fail, that's going to trigger that automatic across-the-board spending cuts of over $1 trillion in nearly a decade. Are investors concerned at this point that that figure won't be enough to sustain growth and create jobs?
Well, I think that first off, it's sort of a confirmation of the cynicism that does surround Washington at this point, that they really can't get an agreement to get their job done. At the same time, it does put up questions as to what could happen to the U.S. credit rating. Could that raise borrowing costs, et cetera? And as you said, is it really going to be enough to help us not go the way of Italy, Ireland, Portugal, et cetera?
And Sam, I know we've talked in the past, and we should point out that obviously you are not on the credit rating side of S&P. But if Congress does try to dismantle those cuts, could that lead to another downgrade for the U.S.?
Well, I think certainly it's a reason for the speculation and for the worry. Certainly, we do operate separately, the equity side from the debt rating side. And so I know about as much about that as you do. But if the statement has been that because of the lack of coordinated effort to resolve our debt issues caused the first one, well, then a continuation of that could cause the second one. So we have to wait and see.
Sam, on Sunday, Spain became the third European country in as many weeks to change its government because of concerns brought on by the Eurozone debt crisis. Spain's jobless rate right now is over 21%. How will the new leader, Mariano Rajoy, lower Spain's borrowing costs while at the same time preventing the country from falling into another recession?
Well, I think that's the concern that a lot of people have, is you are definitely walking a fine line, a tightrope, whatever analogy you want to use, because you don't want to tighten too quickly, too severely, and then choke off whatever economic growth there could be or exacerbate the unemployment situation that you're speaking of. So the concern also is that because you don't have your own currency that you can then devalue to make more attractive from an exporting perspective, it does make it more challenging.
If more European governments fall and those mounting debts aren't addressed, how will U.S. growth be impacted?
U.S. is connected to Europe by about a 15% exposure with exports, and I think while most people anticipate that Europe will probably slip into recession in 2012, if not there already, we don't think it'll be severe enough at this point to drag us in. But I think that too is a concern, that if we find that a liquidity freeze, growth decline across the board to the larger nations like Germany and France occurs, then that could drag us down as well.
Sam, about 30 seconds. Today's market action aside, how do you expect equities to perform in the coming year? Is the market poised for a breakout move?
Well, from a technical perspective, our belief is that get down to about 1150 to 1175 on the S&P 500, and that could set us up nicely for a rally to about 1375, maybe even 1400 in the coming 6 months.
Sam Stovall, he's the Chief Investment Strategist at Standard & Poor's, joining us from his office here in New York. Sam, it's always a pleasure. Have a good Thanksgiving.
You too, Mark.